Good evening, everyone. I'm CA Deepika Agrawal, the moderator of this webinar. We are delighted to welcome you all in this webinar being organized by CCLEA and NPO Committee of ICAI. It is my pleasure to be over here in the webinar discussing on FEMA background ODI and form fillings, being organized by Committee on Commercial Laws, Economic Advisory and NPO Cooperative of ICAI. In a short while, we will start this webinar. I would like to apprise you about CCLEA and NPO committee. This committee is focused to encourage chartered accountants to shape strategy and policy that unlocks economic, financial, and social value while combining analytical foresight with commercial acumen. One of the core areas of the committee is to serve the multifunctional task of analysis, knowledge dissemination, inputs to regulators on policy formulation, to develop and publish technical guidance, background materials, etc., and to create awareness for professional opportunities for chartered accountants in commercial laws, economic advisories, and NPO cooperatives. Our eminent speaker will talk on FEMA, background ODI, and form filings in this webinar, and we hope that the same shall be useful to members. We welcome Mr. Amar Goawara. He's a chartered accountant and a fellow member. He's qualified in 2013 with over 12 years of professional experience. He is a partner at Messrs. GK Deje and Associates since April 2013, where he handles work related to statutory tax audits, internal audits, corporate taxation, and work related to the Foreign Exchange Management Act 1999. He's part of the team working on two publications for FEMA right now: Handbook on Obligations and Privileges of Non-Resident under FEMA, Handbook on Inbound and Outbound Investments under FEMA. He has taken up various sessions in the previous three batches of the certificate courses on FEMA in online mode. So we welcome you, Amarji, and we hope our audiences will enjoy listening to you, and they will gain insights which will help them in their journey to practice FEMA in a proper manner. The ball goes in your court.
Thank you, ma'am, for a lovely introduction.
Amar sir, Mayank this side.
Yes.
Actually, I wanted to congratulate because today is the last webinar of this council year.
Okay.
Yeah, and we have more than 250 plus participants right now.
Okay.
And I wish you all the best for the upcoming year.
Thank you.
And we wish that we'll continue more webinars with you this
Thank
year.
you. Thank you, sir.
Thank you so much, sir. Thank you.
Thank you much, sir.
You can continue now.
Thank you, ma'am, for the introduction. Thank you, the Committee on Commercial Laws, Economic Advisory, and NPO Cooperative of ICI for giving me this opportunity. A very good evening to all my colleagues. Kindly allow me a minute just to share my screen. Yes. So today we shall be discussing about the history of the Foreign Exchange Management Act, how it came into play and its background. Then we will go into the technical session of the overseas direct investment. Later on, we will take into account the form filings, and we will try to take into account all the requisite form filings which are there in FEMA, including for FDIs as well as ODIs. Also, we will take up transfer of shares form filings in FEMA and annual returns also, which are required in FEMA. So first, before studying any section or before studying any act, it is very important to understand why it was implemented. When we study the Income Tax Act and we study the latest budgets, we study the latest updations, we first try to understand why this section was brought into place. So before going to the ODI, before going into the Foreign Exchange Management Act, I would like to briefly take you through the history of the Foreign Exchange Management Act and how it came into play. Now, since years, each country has been dealing with each other by way of import and exports. So wherever there is exchange control, wherever there is foreign exchange transactions, there has to be some exchange control laws. So the Britishers introduced the exchange control laws in India in 1939. After India got its independence, came our FERA 1947, the Foreign Exchange Regulation Act 1947. Now, what most of us know is that the current Foreign Exchange Management Act is preceded by the Foreign Exchange Regulation Act, but that is the FERA of 1973. There was another Foreign Exchange Regulation Act of 1947 which precedes this FERA of 1973. Now you have to understand India has just got its independence in 1947. Of course, there's a lot of significant economic challenges in the country, and it had to manage its foreign exchange reserves. Also, if you see the worldwide situation, there was an aftermath of the World War II. So there was a heavy disruption of trade and scarcity of foreign exchange throughout the world. Now, this main aim of this FERA 1947 was to regulate the payment in foreign exchange and to conserve the foreign exchange. It was comparatively less stringent than the FERA of 1973. FERA of 1947 was more focused on managing foreign exchange through a regulatory framework rather than through strict enforcement. Now, over the years, economic challenges evolved and there were calls to strengthen this act, which led to an introduction of a more comprehensive and a stringent version of the act, which is the FERA 1973, which we all know. Now, the FERA of 1973, it came into effect on the foreign exchange. Now, if you see the current FEMA, its main aim is to manage the foreign exchange. While the Foreign Exchange Regulation Act main aim was to control, conserve, and regulate the foreign exchange. Now, when you talk about control and conserve, there will be more stricter penalties. There will be more lot of, more paperwork involved. The structure will be more cumbersome and more difficult. So FEDA introduced strict penalties, and any violation were treated as criminal violations. And majorly, if you wanted to deal in foreign exchange, you had to go and get the RBI approval for majority of the transactions. Now, since 1947, after the World War II ended, the other countries have started opening up. They started liberalizing the economies and they started opening up. But because of the FERA 1973, we can say India went into a little bit of economic isolation. Now, India felt its main pinch in the year 1990, where we faced a severe balance of payment crisis. Now, what is this balance of payment? Now, each country makes import and export transactions with other countries. So, each country needs to earn enough foreign exchange through its export sales so it can cover making the import payments for its purchases. This is the balance of payment. Now in 1990, the prices of crude oil increased, and we all know India imports a lot of crude oil. So the prices of the crude oil increased, by which and we had very less foreign exchange reserves in order to make the payment. You can see there was a fact India had only enough foreign exchange reserves to meet 3 weeks of its imports. So there were a lot of it was a time of economic challenges. So the government did take up a lot of plans, but these were all the short-term plans. They tried a lot of short-term measures. What they tried was they tried pledging the gold of a country and tried to take loan from the international banks. There was in one case where there was some gold confiscated from some smugglers and that was sold to earn foreign exchange. Now, these were all short term measures, and the government knew a long term solution was required. These came through the three emblems: the privatization, liberalization, and globalization. A lot of changes came into place. There was a deregulation of the industrial sector, privatization came into place. In the financial sector reforms, the privatization of banks took place. So this led to your HDFC banks, ICICI banks, IDBI, UTBI. So these all came into existence. Now, when privatization of banks takes place, RBI, which was a regulator, became a facilitator. And to have private banks operating under it, it had to strengthen its regulatory framework. Like in our office also, if we need to have a regulatory framework, we need to have a system wherein everyone understands each and every duties and responsibilities. A lot of capital adequacy norms were set up, asset classification standards were set up, and it was aligned with the best international practices. The income tax, there was changes in the income tax also. Earlier, the income tax rate were quite high. The slab rates were quite complex. So there was a reduction in the slab rates. There was a reduction in the income tax rates. Now the foreign exchange reforms. The main reform was the Foreign Exchange Management Act 1999 came into force with effect from 1st June 2000. This FEMA replaced the earlier Foreign Exchange Regulation Act of 1973. Now, the FEMA is more liberal and it aimed at facilitating external trade and payments. Its main aim is to develop and manage the foreign exchange transactions. Now, why it was required? Because of the see, India was getting India had opened up its economy. There was a policy of liberalization. A new industrial policy of 1991 had been set up. Now, to work accordingly, the shackles of regulatory and legal provisions had to be removed, and the steps to be dealing in foreign exchange had to be made more easier to allow India to trade freely with the world. And you can see over the past few years, India has earned a lot of foreign exchange reserves through its policies. If you see, earlier the foreign exchange reserves in 1998 were around 27 US billion USD billion dollars. In 2024, it is 650 USD billion dollars. So you can see that there's a big increase in the foreign exchange reserves which the country possesses. So, for moving from FERA to FEMA, India transited from an era of regulation, control, and prohibition to a new era of consolidation and management of forex reserves. So, we just go to a differentiation between FERA and FEMA. FERA main objective was to control, conserve, and regulate foreign exchange. FEMA main objective is to manage and facilitate foreign exchange. The assumption for FERA was that foreign exchange is a scarce resource and hence it must be protected and used with great care. While with FEMA, the main objective is, or the main assumption behind it is that foreign exchange is an asset and it must be properly managed. In FERA, any violations were considered as criminal offenses, while in FEMA, it was more emphasis on compliance and the penalties were civil penalties. So FERA, it was little restrictive in nature. It aimed at protecting the Indian economy. While FEMA has a more liberal approach, it encourages foreign investment and trade. The regulatory framework was for FERA was central government. For FEMA, it is the RBI. The FERA, in fact, there were a lot of sections in FERA. There were around 81 different sections and provisions. In FEMA, there are around 49 simple sections. But I'm saying 49 simple sections, but then we have rules, regulations, directions, FAQs. Okay, so a lot of literature to read, a lot of literature to understand, because for every subject like overseas direct investment or foreign direct investment in India, we have to go through the rules, regulations, and directions. Press notes are there, so circulars are there, so we need to study all of them. So as I said, FEMA helped get a lot of inflows of FDI in the country. It removed the obstacles in the inward flow of forex and investments. Now, when FDI comes in, it leads to an employment generation because the companies grow, leads to employment generation. Now, a lot of businessmen, now they have a choice whether to go in for for whether to go in for borrowings or to raise capital by way of FDI. If a businessman wants to expand, he can either borrow money or he can get in a foreign investor. Now, borrowing, of course, the interest is the pinch. It is going to pinch you each year and each year, each month and each year. But when you get a foreign investment, of course, there will be sharing of profits, but you won't have the pinch of the interest. And if without that interest, maybe you may be able to make more profits and you will be able to expand your business much better compared to taking a loan, and which also helps in sharing of the profits. If you see even in our clientele also, a lot of the Indian businessmen are venturing outside. They are either trying to invest in foreign countries, they're trying to invest in foreign subsidiaries, or they're getting in a lot of FDIs. So I am basically based in Pune, and over here also there are a lot of entities who have got FDI and they've built some beautiful real estate projects. So if you can see, we read earlier there was a time where we had only 3 weeks of import payment, foreign reserves up for making only 3 weeks of import payments. Whereas by 2024, we had enough foreign exchange reserves to meet 11 months of import transactions. Now, there is a huge opportunity in FEMA for us practicing chartered accountants. There's an untapped market and very few consultants. Now, what happens is when any entity or when any businessman is trying to venture outside or trying to get in FDI, when he wants to give this FEMA related work, they always try to look in for specialized consultants. They normally do not prefer to go to their own CS. They want to go to a specialized person who knows in FEMA. Why? Because there's a fear of the ED, there's a fear of the RBI, and you're dealing in foreign exchange, so you want to go to a person who knows the law. So there's a lot of potential for us. We've all seen even in our internships or where we work, there's not enough work of Foreign Exchange Management Act which we have done. So there's scarcity of technical people available, and therein lies a chance to make a mark. Like the way GST, when GST came into play, see, there were a lot of senior consultants who were dealing in VAT, who were dealing in service tax. But when GST came into play, people like us who were not much aware about service tax VAT also got a chance to put a foothold in it. Now, how do we start a consultancy? First of all, we have to look into our own clientele itself. We may have individual clientele who may be non-resident Indians as per the FEMA. Now, if there's any individual who is a resident of India and now he has gone abroad for some work, or who is gone abroad and started living abroad and has become a non-resident Indian, he has to change his bank accounts. Now he has to change his bank account from a resident savings account to a NRO account or an NRE account. Similarly, if an NRI comes back to India, he has to change his account from his NRO account and NRE account to its resident savings account. Also, we may be doing audits of various corporates who are doing a lot of export and import transactions. Now, FEMA also has rules and regulation with respect to export and import transactions. Like if any entity has done an export sale, it has to realize its exports proceeds within 9 months. And if it has done an if it has made an import transaction, it has to make the payment to the foreign vendor within 6 months. Then there are a lot of cases wherein the individual clients who wish to make gifts to their foreign relatives or who wish to buy property abroad. So we need to know the liberalized remittance scheme wherein a resident individual can transfer up to USD 250,000 overseas to his relatives. Then there's a $1 million scheme for the non-resident Indians who can transfer up to $1 million per year for making foreign payments. So these current account transactions, capital account transactions. So this we can educate our own clientele if they are having these existing transactions. Now what happens is, if, for example, if I am an auditor of a company, now this private limited company wishes to make an overseas direct investment. That is, it wishes to invest in a foreign entity. He will not be able to do it unless he gets a statutory auditor certificate from his statutory auditor. So his statutory auditor will have to certify and give that certificate. Only then can he do an overseas direct investment. We will when we will be studying about ODI, we will be reading about the statutory auditor certificate which is required and which we have to certify, which is a key point in making these overseas direct investments. Then any overseas transaction you do, you require documentation. If you're making an overseas investment, you need to make the form FC. If FDI is being received, you have to file the form FCGPR, or maybe the form LLP1, form LLP2. If there's a change in number of shares between a resident and a non-resident of a Indian company, then you have to file the form FCTRS. So a lot of form filings are involved, a lot of documentation are involved, wherein we can help. And also there are annual returns are required, like form APR, form FLA. So it gives us a lot of opportunity and a lot of work in this field. When there's a transfer of shares, or when there's a talk about FDI or ODI, the valuation of shares also comes into play. So we can help in the valuation of shares also as chartered accountants. Points to ensure while taking a FEMA work. First of all, the timelines are important. You have to meet the timelines. If the timelines are not met, then you have to pay that penalty, and you don't want to go into that. Accuracy, it has to be accurate. What we suggest is, you should always have a checklist and a list of documentation which will be required ready. So if a client tells us, okay, he wishes to make this particular transaction, so we should be able to send him the checklist and the list of document required as soon as possible. So we should have that checklist available with us. What all documentation will be required for getting this transaction done, or what all form filings will be required. That all we should be we should be aware about. Now, what we also suggest is, when a businessman is going to make a transaction, we always advise him to keep his AD bank in the loop, and also share all the documents in draft format to the AD bank beforehand, before signing of the documents. So the AD bank can also have a look in the document and can suggest if there are any changes required, or if there's any problem in the documentation. Now, a lot of form filings are involved, and a lot of forms are online filings. So you should always keep enough sufficient time for your online filings. So suppose if you have to, suppose for FCGPR, you have to file the form within 30 days. So you should have sufficient time, because there may be some problems while you are filing online. Of course, the RBI portal is quite helpful in that case, but you should always preempt there may be a problem, there may be a technical glitch. So you should always try to file the forms before the due date, and not wait for the last date. So how to master the subject? Of course, first thing, we have to study the law. But how to study the law? This we will try to also understand. We will try to find out the rules, regulations, and directions of a particular subject, and we will try to see what we have to study. Help of ICI and the committee. They're setting up a lot of seminars, certificate courses, study circles are there. ICI also has come out with a couple of handbooks on Foreign Exchange Management Act. And finally, a network. So the broad contents of the act, will now come back to the FEMA Act. So the broad contents of the act, basically the act basically gives powers to the central government and the RBI to frame the rules and regulations. So the act is basically giving the permission. You have to see the rules and regulations, whether they are allowing and how to go about the transaction. But the act will be pre-binding, and so we just go through the act. The section 2 is for the definitions. Section 3 to section 9 is for the regulation and management of foreign exchange. Section 2C and section 10 to 12 is with respect to the authorized dealer banks. Section 13 to 15 is for contravention and penalties. Section 16 to 35 is for adjudication and appeals. 36 to 38 is for enforcement directorate, and 39 to 49 are miscellaneous provisions. So the rules are notified by the central government, and the regulations are notified by the RBI. So both contain the law and the procedure to make law. Now, these rules have to be placed before the parliament to become enacted. Then there are also, so what all we have to study first is the act. But the act gives all the powers to the RBI and the central government to frame the rules and regulations. So basically, you have to go and study the rules and regulations. And the third thing, the master directions. Now, these master directions are actually issued by the RBI to the AD bank, because Now, RBI has made the AD bank responsible for checking all the documentation and approving all the documentation. So, unless unless your transaction requires prior RBI approval, it it will be approved by the AD bank. So that is what FEMA has gotten. It has reduced the workload of the RBI and made the AD bank responsible for checking the documents, for approving the documents. So these master directions are issued by RBI to the AD bank, instructing them about the documentation or what all things to be checked or what all things to be kept in mind while checking the documentation. So we should preempt those, and we should be our documentation should have it perfectly. It should have what all the directions require also. Then we have the master circulars. Basically, these are all the consolidation of all existing guidelines and instructions on a particular subject by the RBI. Then we have the press notes. Now, these press notes are issued by the Department of Promotion of Industry and Internal Trade. There are a lot of government agencies also who are involved in this, in the form filing or in the approval in respect to the act. For example, there is one form of Form DI, where is a form of direct investment, sorry, form of downstream investment, wherein an entity who has received FDI wishes to make a downstream investment in another entity. So they have to file the form in the RBI also, and we have to file a form in the DPIIT portal also. So you should always check whether any form filings at the government portals is also required or not, apart from the filings at the RBI. Then RBI issues a lot of FAQs also, and it will answer a lot of our questions. So it's a must read for us. Now, how do we search about the act? So what I'll do is I'll just escape from my PPT and we will go to the site and we will try to find the latest rules, regulations and directions. Now, what I suggest is if you want to study a particular subject, try to find the master directions for that subject, because the master directions has a link to its latest rules and regulations. Now the problem what we face is that the rules, regulation, directions, they keep on they are updated each year. So or they are updated regularly, we can say. So how do we know which is the latest directions or which is the latest rules and regulations? So this I will guide you. So I've just exited my PPT, and I think you can see my RBI portal. Just check if it's seen. Yeah. So in the RBI, I'll just go to the legal framework. I'll just search on anything, rules, regulation, directions. You can just click on anything. In the search, I'll say overseas investment. Overseas investment. Yeah. So I'll say these are just some keywords which help us search faster. So I've searched overseas investment over here. Now I'll search with the exact phrase. I'll update the result. Now, if you see there, any subject or any chapter which has this overseas investment, the link will come over here. But I am trying to find the latest master directions for the overseas investment. So right now I cannot find anything on this page. So I'll go to the second page. And nothing over here. Yeah, over here I can see the master direction overseas investment, which is updated as on November 28, 2025. So which is the latest one. So I'll just click on that and I go to the latest master direction, again updated as on November 28th, 2025. Now, once I'm on the master directions, if I can just see, there's a link of the rules and there's a link of the regulations. So if I can just click on the rules, I say open link in new tab. I I get the latest rules because it is linked to the master direction. So it have to be the latest rules. So it's there in Hindi as well as English. And again, if you see the overseas direct investment rules are updated as on 2022. Now we try to go to the regulations. Again, I just click over here. And if you see, again, updated as on 2022. So this is the way we find. Now we will try to go into the FDI. We will try to find the rules, regulations of FDI. I'll just copy my keyword, which just helps me find it faster. Again, I'll do search with the exact phrase. Again, there'll be a lot of points mentioned over here, but I'm looking for the master directions. Master direction foreign investment in India. So I got the foreign master directions for the foreign investment in India. I see it is updated as on 20th January 2025, so which is the latest master directions. It will have the link of the latest rules and regulations. Now, when you talk about FDI, the rules are basically the name is Foreign Exchange Management Non-Debt Instrument Rules and Regulations. So these are the regulations, and we can see the rules also somewhere over here. So here, non-debt instrument rules. So if you just click on this, you will go to the latest rules. Again, updated as on 15 Jan 2025. Same with the master directions. Same with the rules. Okay. So now just come back to my PPT. Yeah. So overseas direct investment. So what do we mean by overseas direct investment? Basically, if any entity wishes to make a foreign financial commitment, or let's say wishes to make a financial commitment in a foreign country, it will come under the ODI rules. Now, which are the type of financial for giving a guarantee for a loan taken by a foreign company from a foreign bank? Fourth, there can be pledge of shares by the Indian company of the investment held in its foreign subsidiary for the foreign subsidiary to get a loan. So these are the various forms of overseas direct investment, or let's say various forms of financial commitment which comes under the overseas direct investments. Now, who all can make these overseas direct investments? When I say entity, I say private limited company, even an LLP, even a partnership firm can make an overseas direct investment, including also an resident individual himself can also make an overseas direct investment. Of course, the rules and regulation with all of them are different. We will study the same in detail in the later slides. So now, if you want to study about the overseas direct investments, this subject, uh, the last updation is in 2022. So RBI has updated its latest rules, regulations, and directions in 2022. So if you study the master directions, rules, and regulation of 2022, you can study the whole subject. The master direction again has been a little bit updated, and master directions of 2024 also has come up, but it is same in line. So you can study the rules and regulations of 2022 and the master directions of 2024. Sorry. So now we will look into the definitions in this overseas direct investment and the key changes of this ODI. Now, what is the meaning? They have brought in the definition of foreign entity. So foreign entity means any entity formed or registered or incorporated outside India. Hence, it includes LLPs too. And registration is not compulsory. So, foreign entity means any entity formed or registered or incorporated outside India. So, LLPs are also covered over here, and it may or may not be registered. Earlier, when we used to speak about overseas direct investment, we used to speak about an Indian entity investing in a foreign joint venture or a foreign wholly owned subsidiary. Now, these words joint venture and wholly owned subsidiary has been replaced with foreign entity. So now when we will talk about an Indian entity or a resident individual investing in a foreign entity. Now, what is the definition of an Indian entity? Indian entity includes companies, body corporates, LLPs, and even partnership firms registered under the Indian Partnership Act. So these all entities can make overseas direct investment as per the rules and regulations. Now, an important change which came into place in the 2022 rules and regulations was now an Indian entity who is not engaged in the financial service sector can make an overseas direct investment in a foreign entity who is not who is involved in the financial service sector, except banking and insurance. Earlier, the rule was, and only an Indian entity who is involved in the financial service sector can make an investment in a foreign entity who is in the foreign financial service sector. But now it is done away with. Now, what is the meaning of the financial service activity? The financial service activity has been defined as an activity if carried out in India, it requires registration or is regulated by a financial service regulator in India, that is the RBI. Now, there's a big change in the definition of control. Now, when we look into what is the meaning of control, let's look into the Indian parlance or Indian laws parlance, or if we say Companies Act, what is it? When can we say and one entity exercises control over the another as per the Companies Act? First, by the right to appoint majority of the directors. Secondly, by controlling the decision making and the policies. Thirdly, when we talk about control through shareholding, we say if an entity holds more than 51% shares in another entity, the first company is exercising control over the another. But over here in ODI, they have said if an entity has 10% or more voting rights in another entity, the control has been exercised. So the key points for understanding control: if an Indian entity has the right to appoint majority of the directors of the foreign entity, if it can control the management of the foreign entity, control the policies of the foreign entity, or by virtue of shareholding, if it has 10% or more shareholding in the foreign entity, the exercise of control is kept. Now, why is this very important? If we will see the second point, what is the definition of a subsidiary or step down subsidiary? So, subsidiary or step down subsidiary of a foreign entity means any entity in which the foreign entity has control. Now, control we have defined 10%. So, by 10% it will become a subsidiary as per FEMA. Now, when we go into the ODI rules, there's one major restriction. This restriction says that an Indian entity cannot invest in a foreign entity who has invested back in India up to two levels of subsidiary. Now, there are very important things to understand in this line. So I'll repeat it again, and will put some time in understanding this two lines. An Indian entity cannot invest in a foreign entity who has invested up to two levels of subsidiary in India. First thing comes key level of subsidiary. Matlab, we have said if an entity holds 10% or more in another in another company, control is exercised and it becomes a subsidiary. So even if that foreign entity holds 10% in an Indian entity, it becomes a subsidiary. So while checking that, while evaluating the layer, you have to take into account 10% shareholding and not 51% shareholding. Okay. Now, again, one thing that hits the mind, this line somehow does not look right. It does not seem right. An Indian entity cannot invest in a foreign entity who has invested in India up to more than two levels of subsidiary. That means an Indian entity can invest in a foreign entity who has invested in India, it was invested back in India up to two levels of subsidiary. That is allowed. When they have mentioned this restriction, they have tried to restrict a foreign entity investing back in India up to more than two levels of subsidiary. But by mentioning that, they have allowed that a foreign entity can invest back in India up to two levels of subsidiary. Now, in a mind, it sounds like round tripping. But of course, it cannot be in the same group. Like for example, an Indian entity has invested in a foreign entity. Now this foreign entity invests back in its own group company. So now that will not be allowed. That will be round tripping. But yes, if an Indian entity is invested in a foreign entity and that foreign entity wishes to globalize, it wishes to expand. Now, while expanding, it also wants to expand in India. So it invests in some other companies in India. So that it can do up to two levels of subsidiary. Now, the definition of net worth has gone a critical change. Now, why is this important is because while the main condition for making an overseas direct investment is you cannot, any entity cannot make an overseas investment more than four times its net worth as per its latest audited financial statements. So the definition of net worth plays a key role. Now, earlier in the earlier ODI rules, the net worth included only paid up share capital and free reserves. Now, the net worth has the meaning of section of clause 57 of section 2 of the Companies Act. Now, if you go through that section, it includes security premium account also. So if there's an Indian entity who has maybe issued shares at a premium, has a good enough security premium, its net worth has increased, so it can invest up to 4 times its net worth. So that gives it more amount to invest. Now, when we say, see, for an Indian entity, it's very easy to understand the net worth. When we say a private limited company, it is very easy to understand the net worth. But we have said ki even a private limited even a partnership firm and even an LLP can make overseas direct investment. Now, how will they be able to ascertain the net worth? So, a net worth for an LLP or a partnership firm is the sum total of its capital contribution and its free reserves, undistributed profits. So, you can say it's capital account and current account. That is the net worth of the LLPs and partnership firm. Of course, there should not be any deferred expenditure or any miscellaneous expenditure written off. So, that should not be there, which is the same case for the companies also. So, the three major modes of making a financial commitment overseas are: one, investment in equity capital; two, investment in debt instruments; three, financial commitment by way of a guarantee. As I said, and any Indian entity can invest up to 4 times its net worth, 4 times of its net worth as per its latest audited financial statements. You say 400% of its net worth or 4 times its net worth. So any Indian entity can invest 400% up to 400% of its net worth. Now you have to calculate this cumulatively. When we are seeing how much it can invest, you have to see it, the total overseas investment. He must have made investment in 2 3 companies. So the total overseas investment cannot exceed 400% of its net worth as per its latest audited financial statements, not exceeding 18 months. Now, not exceeding 18 months, we will just understand in detail in the next slide. Now, there's a catch. If a foreign commitment in a financial year exceeds 1 billion US dollars, then approval of RBI is required, even though the financial commitment of the Indian entity is within the eligible limit of under the automatic route. Now, there may be some cases where an Indian party has earned foreign exchange outside India and has deposited that foreign exchange in their foreign currency account, in their exchange earners foreign currency account. Now, which it is allowed to do if it is allowed to do it as per the FEMA rules. If it is allowed to make this account as per the FEMA rules, he can use this proceeds itself to make an overseas direct investment, and it will not come under the part of ODI. He can freely do that. Or if any Indian company has raised funds to its ADR or GDRs, so basically they have raised funds in foreign currency. So then that foreign currency directly they can invest for making an overseas investment. Now earlier there was a concept of utilizing the net worth of the subsidiary or holding company also. Now that they've discontinued with. You have to see the net worth of the entity which is making the overseas investment. So while we were doing our ODI transactions, there were a lot of practical challenges which we faced. So these challenges I've tried to put in the form of case studies. Now, we mentioned the prime condition for making an ODI is you can make up to 400% of your net worth up as per the latest audited financial statements. Now, there's a company, XYZ Private Limited Company. It has prepared its financial statements under Indes. Let's say I'll just start again. There are two companies, XYZ Private Limited and ABC Private Limited. Both companies have issued redeemable preference shares. Now, one company, XYZ Limited, prepares its accounts in Ind AS, while ABC Private Limited prepares its account in accounting standard, in the GAAP accounting standard. Now, we all know in our GAAP, in our accounting standard, when redeemable preference shares are issued, it is treated as a capital. It is treated as a preference share capital, and it is a part of the net worth. But in Ind AS, this is treated as a liability. It is not treated as a capital, but it is treated as a liability. It is treated as a borrowings in Ind AS. So both companies have issued a redeemable preference shares. For one of them, it is coming in part of a net worth. For the other, it is coming as a part of the borrowings. So now, what do we consider as a net worth while you're making the ODI? So the answer is you have to go as per the latest audited financial statements. And the latest audited financial statements, of course, have to be as per the standards applicable to it. So if Index is applicable to XYZ Private Limited, those preference shares will be accounted as a borrowings. It will not be from part of a net worth, and it should not be taken into account for calculating the 400 percentage limit. While in ABC Private Limited, it will be treated as a preferential capital. It will be part of his net worth, and it will be treated as a part of the net worth for calculating the 400% limit for making the overseas investment. Now, second question. A Private Limited wishes to make an overseas investment in May 2024. Now, for calculating 400% of his net worth, which year's financial statement should it require? So we all know the financial statement for the financial year for 23-24, you can get your accounts audited up to September 24, correct? Now he wishes to make an overseas direct investment in May 2024. So of course his March 24 accounts may not be ready. So what to be done? So the rule says you have to go as per the latest audited financial statements. So right now, as on May 2024, which will be his latest audited financial statements? It will be of financial year 22-23. So he can use the balance sheet of March 23 for calculating the net worth and calculating the limit of 400% of its net worth. He can use the audited financial statements of March 2023. Now, what if that company has gotten a lot of share capital in the current year, in the year 24-25? So, suppose let's say in May 2024, it has issued a lot of share capital. So, its net worth has increased in May 2024. Now, it wishes to make use of that because uh, he has raised capital to invest overseas. So what he can do is he can also get his special purpose audit done in May 2024 as per his financial statements of March 24. So for example, for example, if he's issued these share capital in the year 23-24 and there's still time for him to submit his statutory accounts, he can get a special purpose audit done in May 24 and he can use that balance sheet also to ascertain the net worth and calculate the limit. Now, another question comes is what happens if he see again we come back to this we come back to the facts first. The company has filed its accounts for year 22-23. Now for the year 23-24, his accounts will be finalized in September. Okay. Now in but it is not yet finalized. His accounts for the year 23-24 are not yet finalized in October 24. Okay. Now in October 2024, he wishes to make a financial commitment, an overseas financial commitment. Which year's balance sheet which he will be required to use? Now in this case, see, he had to get his accounts audited of 2024 by September 24. So he has no choice but to use the March 24 balance sheet only. He cannot use the 22-23 balance sheet because the due date has passed for the March 24 balance sheet. It has to be ready. So if the balance sheet is not ready, he will not be able to ascertain the net worth. He will not be able to make the ODI. So in that case, he will have to get his March 24 audit done. He will not be able to use his March 22-23 accounts for that case. Now what? Now another case now. Suppose X Limited has made an ODI in a foreign entity as per the rules and regulations of FEMA in May 2024 by considering the net worth of his latest audited financial statements of March 23. Okay, by May 24, its accounts are not yet ready, so it has used the financial statements of March 23. Now, after the March 23 financial statements have been signed, after the ODI has been done, his final accounts of March 24 are finalized in August 24. Now he finds out that there's a big loss which this company has incurred in the financial year 23-24, and the net worth has reduced. Now net worth has reduced so much that the initial calculation which he had done as on March 23 net worth, now that has come down below the limit. So he has done more ODI. He has invested more compared to the net worth, 400 times net worth as on March 24. So now what to do? According to me, nothing is to be done. When you are making the overseas investment, it is that time you have to see whether that 400% net worth limit is compliant. That time, March 24 accounts were not yet ready. He was eligible to use the March 23 accounts. He used the March 23 accounts to calculate the net worth. He does not now, once later, if he incurs a loss in 2024, and he does not need to get back that investment. So that is allowed. We go another case study. A Private Limited has a net worth of 10 crores as per its latest audited financial statements of March 24, which are signed in April 24. Now, how much is the maximum overseas financial commitment this company can do? So, four times its net worth. So, it has a net worth of 10 crores. So, it can do an overseas investment up to 40 crores. Okay. Now, it has made an overseas investment of 20 crores in June 2024 in BLLC. Okay. Now, he wishes to make further overseas investment in CLLC in August 24. So, how much can he invest? We'll go to his latest audited financial statements. The net worth is 10 crores. The overall limit is four times the net worth or 400% of its net worth, which is 40 crores. Already he has invested 20 crores in June 24. So now in August 24, he has only 20 crores, which is pending, which is available for him. That much he can invest. So you have to calculate it cumulatively. Now this becomes very important because we had a case wherein the Indian entity had made investments in a different foreign entities, and the investments were also different modes of investment also. In one case it was only investment. In another, the other case it was investment as well as loan. In third case there was a guarantee also. So when I'm calculating how much overall overseas commitment he has done till now, I have to calculate it cumulatively. So I have to keep into track how much overall overseas financial commitment he has done till date. What you should do is, see, because as a statutory auditor, you also have to certify. You also have to give the statutory auditor certificate, and you have to prepare the forms also. So each bank, they maintain a profile of the subsidiary. What happens is, the first time when you're making an overseas investment in a foreign entity, when you file that form FC, you have to file the form FC to the AD bank. The AD bank will provide you a UIN number, a unique identification number. Now this number is for the subsidiary, for that foreign subsidiary. It is for valid for a foreign subsidiary. So any further investments made by any Indian entity in that foreign entity will be come under this UIN. So what you should do is, this Indian entity has invested in four foreign entities. So you should ask the AD bank to provide the profile which it has maintained for these four subsidiaries, for these four foreign entities, by which you will be able to cumulatively know how much overseas investment a specific Indian entity has done in this foreign entities. So when I'm looking as a statutory of an Indian entity, I have to cumulatively add up each overseas investment in each entity plus different modes of investment which it has made in each entity. So it is a very critical thing because it is the main primary point to be taken care while you are making an overseas investment. Now, whenever you are making an overseas investment in equity shares, where an Indian entity is investing in the shares of a foreign entity, there will be a question of the valuation. Valuation will play a key role. What? So as per the rules, the transaction should be at the fair price as calculated under any internationally accepted pricing methodology. So they have not defined a specific methodology. You can use discounting factor method, you can use net asset method, but it should be the method whichever you are using. It should be one which is recognized internationally and one which is suitable for valuing this company. For example, there's a company who is, let's say, an IT company who is who is estimating huge cash flows in the next years. So for him, according to me, DCF will be the best method. If there's an entity who has a lot of assets, a lot of real estate assets, let's say. So for that, maybe net asset method or NAV method will be the better method. So you have to evaluate which will be the better method suitable for valuing this company, and the transaction has to be at the fair price, not more, not less. It has to be at the fair price as per the valuation report. Now, the valuation report either can be done by a chartered accountant or can be done by a merchant banker. Now, what we have seen practically is, I've not seen it in any rules or seen it any regulations, but normally AD Bank asks for a valuation from an merchant banker if the foreign overseas investment by an Indian entity exceeds 5 million USD in a year. So that is mostly what the AD Bank asks. It's not that there are any rules or regulations. Just allow me a minute. Now, second come the FATF compliances. Now, what is FATF? These are basically financial. Now, basically, there's one organization called the Financial Action Task Force. Now, this organization basically is an organization trying to prevent global money laundering or trying to prevent terrorist financing. What they do is they regulate the finances, how the country are operating the finances, and they try, they try to list out certain countries who look like they are engaged in global money laundering or international terrorist activities. So they try to list out those countries. So now when you're making an overseas financial investment, you have to ensure that you are not investing in any foreign entity which is in a country which has been listed out by the FATF as part of its global money laundering or terrorist financing initiative. So it should not be listed out under its restricted sector. So it is very easy to check this. I've mentioned the domain of the website. You just have to go on the website, and it provides regular reports. So if you see on the right hand side, when you log into the website, on the right hand side you will see the reports which it generates. It issues regular reports, and it lists out various countries where it feels this country might be into global money laundering or might be into terrorist financing. So you, when any Indian entity is making an investment in overseas entity, you have to ensure that it is not making any investment in any foreign entity who is in that country, who is part of that country. Now, when we are making an ODI, one important condition is all your previous compliances should be in order. If the previous compliances are not in order, you will not be able to make a future ODI. For example, there's one rule with respect to ODI. Once an Indian entity has invested in the shares of a foreign entity, it has to submit the share certificates within 6 months to its AD bank. So an Indian entity is invested in a foreign entity. Of course, it will receive the share certificates. These share certificates have to be submitted to the AD bank in India within 6 months of the investment. If it has not been done, it's a violation. So if company has made one ODI where investment has been done and the share certificates have not been submitted, he will not be able to make another ODI in any other foreign entity till that past compliance has been regulated. Also, once an Indian entity has invested overseas, and if it has made an overseas financial investment, he has to file a form APR, which is an annual performance report. It's an annual report. So this form has to be filed every year. Currently, the due date is 31st December. So if it has not filed its previous form APR, it will not be able to make any future overseas direct investments. So, for example, an Indian entity first it has made its first investment in the current year. In the current year, at the end of December, it has to file the form APR. If it has not filed the form APR, next year he will not be able to make any ODI before that APR is regulated. Now, we have to be very careful about all these points, because when you are making an overseas direct investment and if you are the statutory auditor of the company who is making this overseas direct investment, you will have to give a statutory auditor certificate for this ODI investment to be done. Now, in this certificate, you will have to certify whether the valuation norms are complied, whether that 400% limit is complied, whether you're not investing in any country where the FATF has restricted, whether all the previous compliances have been done. So you need to document all these thoroughly. So you should, if you're doing an overseas direct investment, always ask for the previous all filings which they have done. Ask for the previous APR file acknowledgement copy, not only the draft APR. You have to ask whether the APR, the acknowledgement copy of the APR. This APR is submitted in hard copy to the AD bank. So you should always ask for the acknowledgement copy of the APR, the acknowledgement copy of the previous ODI submitted, the acknowledgement copy of the share certificates of the previous ODI submitted. Not only you have to ask for the share certificate, you have to ask for the acknowledgement that the share certificates have been submitted to the AD bank. When you submit the share certificates to the AD bank will give an acknowledgement. Yes, these share certificates have been submitted to me. So this acknowledgement you have to keep in your file when you're doing an ODI transaction. Also, there's a form FLA. Form FLA, again, it's another annual report which also has to be filed. The current due date is 15th of July. And this form also, the previous form also should have been filed. Now, what are the restrictions for making the overseas investment? First, the restriction we already talked about. ODI in a an Indian entity cannot invest in a foreign entity that has invested or invests back in India up to more than two levels of subsidiaries. So up to two levels of subsidiary reinvesting is okay, but not more than two levels of subsidiaries. Now, another point, if an Indian entity is investing in a equity shares of a foreign entity and this foreign entity is a startup company, then this overseas investment has to be done out of the entity's accrued funds and not from borrowed funds. Now, again, as an auditor, we have to check this. We have to check this whether there is not whether there is no non-compliance of this. Now, how do we check? First of all, we will need to ascertain whether the investment done in a foreign company, whether that foreign company is a startup or not. So you will have to ask for a declaration. That is, you maybe do a Google search, but mostly you'll have to ask the foreign entity to give a declaration that it is not a startup company. And if it is a startup company, then you have to check that the Indian entity which is making this overseas investment should have only made it out of its accrued funds and not out of borrowed funds. Then again, ODI in any foreign entity which is registered or incorporated in Pakistan or any other jurisdiction as may be advised by central government from time to time shall require prior approval of the central government. So there are some countries wherein the central government has mentioned you require the prior approval of the central government for obvious reasons, and then only you can make the overseas investment. However, these restrictions do not apply to banking companies, NBFCs, insurance companies, or government companies. Now, one again point we discussed, an Indian entity cannot invest in any country which are non-cooperative as per the FATF. Now, there may be some cases where an Indian entity has taken a loan from maybe some banks and has defaulted in repaying these loans. Now it is defaulted in repaying its loan, but now he wishes to make a foreign investment. So that is not correct. So if you know that Indian entity has defaulted in any loan payments, it will it will and you know that a bank or the financial institution who has given this loan has treated him as a non-performing asset or a willful defaulter. This Indian entity will require an NOC from these agencies. Only after obtaining the NOC can he make this overseas investment, because it is not correct. He is defaulted in making he is taking a loan from a financial institution in India. He is not being able to repay the loan, but here he wishes to make a overseas foreign investment. So unless those financial agencies give an NOC, this Indian entity will not be able to make a foreign investment in ODI. Now, another restriction is an Indian entity cannot invest in a foreign entity who is in the real estate sector. Now, what I mean is real estate sector is buying and selling of land or TDR. not development. If the foreign entity is in the development of projects, like development of township, construction of residential or commercial premises, roads, bridges, that is okay. So if the foreign entity is engaged in the development projects, then you can invest in that foreign entity. But if the foreign entity is only in buying and selling of land, buying and selling of TDR, then the Indian entity cannot invest in such foreign companies. An Indian entity cannot invest in any foreign entity who is engaged in the form of gambling, or again, if it is dealing with any financial products which are linked to the Indian rupee without specific approval of the RBI. So basically, in practical cases, the real estate sector will be a major role, because this is what we have to check. When an Indian entity is investing in the foreign entity, you have to ask for its, for its MOA or for its AOA or any document of its constitution, and what exactly is that company doing. Also, in the Form FC, also you have to mention what industry it is engaged in. If it's in the hospitality industry, it is okay. But if it's in the real estate sector, then you have to dig in more deep. So you have to always check what type of industry the foreign entity is engaged in. So what are the documents you require to make an overseas direct investment? Firstly, the Form FC. This Form FC, the full form is Form Financial Commitment. So this Form FC has to be duly filled and signed by the management. So it is, again, this ODI is supposed to be prepared in hard copy and submitted to the AD bank in hard copy. There is no online portal for this Form ODI. It has to be done in hard copy. When you're making the first overseas investment in a foreign subsidiary, a UIN will be generated by the AD bank. It will be This UIN will be consistent for this foreign entity. Any Indian entity making investment in this foreign entity will have to use this UIN number. A statutory auditor certificate will be required. We will be discussing more about this in detail. Board resolution will be required that the board has authorized the Indian entity to make an overseas investment. A valuation report will be required. The underlying document will be required. For example, if there's an investment in equity shares, there will be a shareholders agreement. If there is a loan being given, there has to be a loan agreement. If there's a guarantee being given, then there will be a guarantee deed. So these underlying documents should be there. Then the Indian entity will also have to give a declaration and an undertaking that all the FEMA compliances have been complied with. So basically, see, as a chartered accountant, we will be preparing these documents for the Indian entity, and they will be checking that and signing that. So we have to ensure whether all the compliances of the ODI are properly covered or not, or done or not, because even the management is signing on the documents which we have prepared. And again, we as if we are the statutory auditor of that company, we have to give a statutory auditor certificate also, wherein all these points will be covered. Then we have to go to this FATF. We have to check the FATF compliances. What we should do is, when you're logging into the FATF portal, print out that day's copy, because it regularly changes. Even countries, a lot of important countries like UAE also have featured in the FATF. So you should always look into which whether country you're investing is coming in the FATF or not, because it regularly changes, and you should have a documented copy that when we were investing in this foreign entity, it was not restricted by the FATF. So you should always have a documented copy of that. And a Form A2 will be required. Any foreign remittance to be done, a Form A2 has to be filled up. So these are all the documents which will be required for ODI. So how is the Form FC? So Form FC Annexure 1. Basically, this is the Form FC is Annexure 1 is the form for making the overseas financial commitment. It has various sections. So Section A is dealing with the details of the Indian party or the resident individual, the name, address, what type of industry it is industry it is in. Then Section B deals with the foreign entity, the name and address of the foreign entity, the activity code of the foreign entity, the transaction being taken with the foreign entity, the amount of financial commitment already done, the amount of financial commitment proposed to be done, the proposed shareholding the earlier shareholding of the foreign entity and the proposed shareholding of the foreign entity. So these all come under section B. Section C, again, the transaction based, whether it is a loan transaction, whether it's an equity transaction, whether a pledge is being done. So what type of a overseas financial commitment transaction is being done has to be reported in section C. Section D is the declaration where you have to give declaration about the pricing guidelines, the NOC requirements, whether earlier share certificates submitted, whether there is any delay in previous reporting. Now, if resident individual is making an overseas financial commitment, the main rule or regulation for him is, see, we discussed if an Indian entity wishes to make a investment in a foreign entity, it cannot exceed 400% of its net worth. But what if a resident individual is making the overseas financial investment? It will not he will not have a net worth basically. So for him, there's no limit of the net worth. There's a limit of the liberalized remittance scheme. That is, a resident Indian can only make a foreign financial commitment up to 2,50,000 USD per year. That LRS, the liberalized remittance scheme limit, he cannot exceed that. There are more rules and regulations but that 400% net worth criteria gets replaced with the LRS criteria. Then section E is the statutory order certificate. This certificate is a predefined format. If that clause is not applicable to you, you have to mention in the end not applicable. You should not remove that clause from the certificate. All the clauses will have to be there in that certificate. If it is not applicable for the transaction, you in the end you just mention not applicable, but you cannot remove that from the statutory order certificate. We will look what all the statutory order certificate requires also. Section F is basically there's some restructuring of the balance sheet of the foreign entity. So that is section F. Then section G is if there's a disinvestment by in the foreign entity by way of sale, transfer. So then section F and G comes into place. But if an ODI is being done at the time of overseas investment, you will have to fill section A, B, C, D, and E will be required. Now, Form FC Annexure 2 is part of the form. Now, that is the annual performance report. This is not required to be done at the time of making an ODI. This is an annual report which has to be submitted at the year end, which is right now the due date is 31st of December. So, what all is covered? What all questions are asked the statutory certificate? First question is whether the first we have to certify that the remittance is not in violation of the provisions contained in Rule 19 of the Foreign Exchange Management Act, Rule 2022. Now, what is the Rule 19 of the FEMA rules? It is the restrictions and prohibitions, which we read in the previous slides. The restrictions and prohibitions, the which sector it is investing in. It cannot invest in a real estate like trading of land, trading of TDR, or it cannot invest in gambling of any form. So you have to go into the restrictions that you have to certify that it is not investing in any sector where it is restricted. Then secondly, you have to certify that a total financial commitment along with the proposed financial commitment does not exceed 400% of the Indian company's net worth. Third, you have to certify whether this transaction is within the pricing and valuation norms as suggested by the rules. Again, it has to be at arm's length price as per the internationally accepted valuation methods. Now, there are various questions like if the ODI is being done in a financial service activity, then whether the conditions for investing in a financial service activity have been taken place, have been covered or not. So we will discuss about this in the later slides. So if an Indian entity is investing in a foreign entity who is engaged in financial service activity, the main condition is it has to have net profit for the past 3 years. Then only an Indian entity can invest in a foreign entity who is engaged in a financial service activity. So whether this condition has been satisfied, this you have to certify. Then whether regulation 12 of the rules, whether regulation 12 of the foreign exchange regulations have been complied with. What that regulation 12 says is any previous compliances whether have been done or not. So it states that a person resident in India who has previously made a financial commitment in a foreign entity shall not make any further financial commitment directly or indirectly towards such foreign entity or transfer such investment till the delay in reporting of earlier ODI or share certificate is regularized. So you have to certify this in the statutory order certificate. So we should have the documented proof of the last APR filed, the acknowledgement of the last FLA filed, the acknowledgement of the share certificate submitted to the AD bank. All these acknowledgement we should have. Now, if the remittance is on a personal guarantee, whether the rules and regulations with respect to the personal guarantee have been complied with or not. So we will go through the rules and regulations of the personal guarantee and the guarantee in the next slides. So what are the checklist should be there for Form FC? See, you should always understand money when you are making an overseas financial commitment. Basically, money is going outside India, an Indian entity is committing, is making a financial commitment overseas. So RBI is involved, AD is involved. So the checklist, the documentation has to be thorough. The AD bank is also going to check all the documentation. Um, the statute should always get the underlying document of the ODI also. Suppose an Indian entity is investing in the foreign equity shares, so it should have the underlying shareholders agreement. If Indian entity is giving a loan to a foreign entity, that loan agreement should be there. So that underlying document of the transaction should be there. Then you should have the calculation of the total financial commitment which the Indian entity has made till date, and whether it is up to the 400% of its net worth. You have to document the sector, in which sector the ODI is being made. You have to ask for the underlying document of the foreign entity. Then, as I said, you have to check whether all the previous compliances have been done. So you have to have all these acknowledgements, and you have to document that the previous acknowledgements have been done or not, because you are certifying that. Again, a management representation letter. We have to go as per the auditing standards. So in our auditing standards, we all have to get a management representation letter. So same is the case over here. You're giving a certificate, you should always have a MRL. The auditor should give appropriate disclaimers in the certificate. See, you cannot change the form of the certificate, but you can add disclaimers. Of course, you cannot disclaim something which you have to actually certify. For example, you cannot disclaim something like you cannot calculate the 400% net worth. You cannot give a disclaimer for that. But certain things, if you want to just bring into light, you can add a disclaimer. Now, this 400% calculation of net worth also, you should have a proper documentation, because we also had a tough time. There was an Indian entity who had made investments in a lot of foreign entities. So to keep a track how much investment has been done up till now, because in our office also the people change. People who had made the last ODI documents may not be present today. So we might not know what is the last ODI investment which has been done. So this all has to be documented. The working should be there. You should always ask the bank also to provide those the profile of the foreign subsidiaries. How much overseas investment has been done in these foreign entities by this Indian entity. This should always be there and documented. Now, preferably, all transactions relating to a joint venture or a wholly owned subsidiary, all transactions relating to overseas investment in a particular foreign entity should be done from one branch of the AD bank only. See, you can change the AD bank, but there's a big procedure. You require the NOC of the old AD bank, then only can you switch to a new AD bank. Why? Because again, that 400% limit. How will the new bank know? How will the new AD bank know how much foreign overseas financial commitment have you done till date? So this new AD bank will require an NOC from the old ODI, old AD bank, and it will require the profile maintained by the the old AD bank. Yeah, how much financial commitment has been done? Because on its own it cannot certify. On its own, it will not be able to calculate that. So always try to always try to have one AD bank and do the transaction through that AD bank, one AD bank only. Now, foreign currency accounts cannot be opened abroad for making this ODI. And Indian entity cannot just open foreign currency accounts abroad to make this ODI. One more important thing you have to certify is if when there's a disinvestment being done, when an Indian entity is disinvested from the foreign entity, it should realize the proceeds within 90 days. So for example, if the Indian entity has sold the shares of a foreign entity to another entity, so it should receive the proceeds within 90 days. or if the foreign entity has liquidated, then also it should receive the proceeds within 90 days. So what happens if there's a delay in reporting of this Form FC? Now, up to three, see, there are two types of delays. First is for your annual returns, and one type of penalties are for your annual return, and one type of penalties are for your transaction-based violations. So if there's a delay in making in submitting the ODI transactions, or there's a delay in submitting the FCGPR form or the FCTR form, which are transaction based documents. Uh, so the penalty is 7,500 rupees plus 0.025 percentage of the amount involved into number of years delay. If there's a delay in filing the annual returns, then the penalty is simple, rupees 7,500 per return. So these penalties are valid up to 3 years. So up to 3 years of delay, you can regularize it by making the penalty payment. After 3 years, it is an offense, and then penalty may be imposed, and you may have to go for compounding. See, this is the case you don't want to go over there, because first of all, if there's a delay, if there's any delay in submitting your ODI transactions, or in submitting your annual returns, the Indian entity itself will not be able to make another future overseas investment. So it will not be able to make another foreign investment. So that should also prevent the Indian entity from making any delays with respect to the same. So any delays in the annual return, 7,500 per return. If any delays in the transaction-based returns, 0.025% of the amount involved into the number of years delay plus 7,500. There's some general permission which are given, which like these ODI investments will not come under the ODI route. It will not come under ODI route. They can easily be done. For example, if there are some non-resident Indians who, if there's some NRI who have some funds in their resident foreign currency accounts. So when any individual was a non-resident Indian and he was living abroad, that time the amount money he earned, he could deposit that in his resident foreign currency accounts when he becomes a resident. Now, any investment from this is not a part of our ODI. He can easily do that. Now, if a non-resident who comes to India for some work for a specific period or up to 3 years, he has his foreign currency reserves outside India, so he can use that money to make overseas investment. It will not come part of a ODI. Any person resident in India may hold, own, or transfer foreign security outside India if such security was obtained by him when he was resident outside India or inherited from a person resident outside India. So, if a person who was a non-resident Indian who at that time acquired certain shares, he can, and then he became a resident, he can easily sell off those shares. It will not come as a part of the ODI. Now we will go through the various modes of the overseas investment that can be done. Now, investment in equity share capital. So an Indian entity can subscribe to the MOA of a foreign entity. That means it can become a promoter of a foreign entity. It can set up a foreign entity, or it can buy the shares of a foreign entity, listed or unlisted. It can buy through maybe bidding process or tender procedures. An Indian entity can receive shares of a foreign entity by way of rights or bonus issues. Now, there may be certain cases where there is some receivable for a foreign entity. For example, an Indian entity has made some exports to a foreign entity. Now, there's an export receivable, there's a foreign exchange receivable. So this receivable can be capitalized and investment can be done. So it can be capitalized in the form of an investment in the foreign entity, subject to that foreign entity is within the sector which is allowed as per the FEMA, and the Indian entity also is allowed to, as per the rules and regulations, is also allowed in the normal course to make this foreign investment. So he can capitalize these export receivables into investment in shares. Then an Indian entity can acquire shares by way of swap of securities. But now again, both the legs of transaction should comply with the FEMA provisions. Then acquisition of share capital can be done by way of mergers, demergers, amalgamation, but it should be as per the laws either of the Indian of either of India or either of the host country. So these are the various ways an Indian company can invest in a foreign entity. Let's say equity shares of a foreign entity. Now, yeah, now any Indian entity who has see, who will receive rights and bonus issue? A current shareholder. So, if an Indian entity is invested in a foreign entity, now this foreign entity issues rights shares or bonus shares. So, the Indian entity can invest in it. Now, when he is getting this rights share, the rights share, though the Indian entity can do it, but it will come as a part of an ODI and he will have to file the Form FC because to acquire the right share also, he has to make that investment, he has to transfer that money, he has to purchase that right shares. So investing in the right shares, that Form FC will be required. When an Indian entity gets bonus shares, at that time Form FC is not required because there's no financial transaction being done. He's just received bonus shares. So for that, Form FC will not be have to be filed. Also, if the Indian entity has received a request for right share and it renounces its right, then also there is no reporting which is required. Now, which are the cases wherein the Indian entity can invest in debt instruments or give loans? So, the first thing you should keep in mind is an Indian entity cannot lend directly to its overseas step down subsidiary. So it has to go channel it. The Indian entity can give a loan only to a foreign entity in which it has control. So an Indian entity can give a loan to its subsidiary. This foreign subsidiary can then give loan to its step down subsidiary. But Indian entity cannot directly give a loan to its foreign step down subsidiary. Now, resident individuals are prevented from, they're not allowed to make any financial commitment by way of debt. A resident individual can make financial commitment in a foreign company only by way of equity investment or by guarantees or by pledge of shares, but it cannot give a loan. It cannot make a financial overseas financial commitment by way of debt. Now, whenever an Indian entity is investing in a debt instruments of a foreign entity, or if he's giving any loan to a foreign entity, that bona fide document should be there. The loan document should be there. Again, the loan should be at the interest. The interest has to be charged. It cannot be an interest-free loan. So interest has to be charged, and this interest has to be at the arm's length price. So any Indian entity investing in a debt security or giving a loan to its foreign entity, interest has to be charged and interest has to be at the arm's length price. Further, this was basically for the loans. The Indian entity can also invest in government bonds, corporate bonds, uh, depository receipts. All can be done. Now, corporate guarantee. Now, there will be a lot of cases wherein there will be a lot of cases wherein an Indian entity has invested in a foreign entity. So that foreign entity has become a subsidiary of the Indian entity. Now, this foreign subsidiary wishes to take a loan from a foreign bank. Now, for this loan, the holding Indian company can give a guarantee. So this also forms part of the overseas financial commitment because a commitment is being done. So an Indian entity giving a guarantee to its foreign subsidiary for taking a loan from a foreign bank, that also results in an ODI, and that is permitted as per the rules and regulations. Now, these guarantees cannot be open-ended. It has to be closed. The guarantee gets closed when the transaction is completed. Now, whenever a guarantee is being given, the guarantee deed should be there and the time limit for the completion of the guarantee should be mentioned in the contract. Now, if it's a performance related guarantee, so suppose if the foreign entity is not able to pay the money, then only the Indian entity has to pay the money. That is the main funder of the guarantee. So, when Indian entity has given a guarantee to the foreign entity, it becomes part of the non-financial foreign commitment. And once suppose the foreign entity has defaulted and the Indian entity has to pay that remittance, so it will not add to his overseas commitment. That non-financial commitment will just be converted to financial commitment, but it will not add. add to the amount of guarantee, because the amount of remittance is being done in exchange of that guarantee. Then there are cases for rollover of guarantee. So rollover of guarantee shall not be treated as fresh financial commitment, subject to the end use, and the terms and conditions should remain the same. Then sometimes you just roll on the guarantee. The guarantee gets rolled on if another loan is taken. So it will not add up. Now, there's one very important point. There can be a guarantee by a promoter or guarantee by a group company. So there's a condition wherein suppose a resident individual who is a promoter of an Indian entity, he can give the guarantee on behalf of the Indian entity to the foreign bank of the financial subsidiary in which the Indian entity has invested. So suppose an Indian entity has invested in a foreign subsidiary, it has a foreign subsidiary. This foreign subsidiary needs some loan from a foreign bank. So the promoter of the Indian entity can also give a guarantee on behalf of the Indian entity. But when the promoter is also giving this guarantee, it will be counted as the financial commitment of the Indian entity. Because see, and for a resident individual, I've told you there's the only limit of 250,000 USD which you can do. Uh, for an Indian entity, the limit is for any financial commitment is four times the net worth. So when a promoter is also giving a guarantee on behalf of the Indian entity, it will be counted as the counted in the limit of the Indian entity when you're calculating the overseas financial investments. Even the group company of the Indian entity can also give a guarantee on behalf of the Indian entity. So the promoter as well as the group company can give a guarantee on behalf of the Indian entity for the loan taken by the foreign entity from a foreign bank. And they've defined group entities also. So basically, group entities are two or more enterprises which are directly or indirectly in position to exercise 26% or more voting rights or appoint more than 50% of the or member of board of directors in other enterprise. So now there's one case study. Okay, A private limited along with another B private limited. Just, yeah. So A private limited along with another B private limited has made an ODI in USA XINC. Now this XINC wishes to take a loan of 100 crore from any bank. The holding company also has to give a guarantee. So now this foreign entity has two Indian holding companies. We have two Indian entities holding control in the foreign entity. So both these Indian entities are required to give a guarantee for that foreign loan obtained. Now, how much will the foreign commitment be considered for the Indian entities? My answer is, see, again, I'll just clarify the question. And a foreign company wishes to take a loan from a foreign bank, and the Indian entities have to individually give guarantee of 100 crore each. Now, for calculating the limit of how much overseas investment each company has done, you have to consider 100 crore each for both the companies and not do 100 divided by 250 crores, because both companies are jointly liable and are jointly and severally liable. So any one of the company may be asked to make the payment. So for both entities, they both individually have to consider 100 crore as the overseas commitment which they have done. While calculating that 400% of net worth, each company has to consider 100 crore that overseas investment they have done. Now, when can an Indian entity make overseas investment in a foreign entity engaged in financial service activity? So there's only restriction. if you see the restriction with respect to the size of activity of the foreign entity, basically you have to see whether it is in the real estate sector or not, or if it is in any gambling form, or if it is any way linked, it is doing any work which is linked to the Indian rupee, or if it is in the financial sector activity. So you have to see whether if the foreign entity is in a financial sector activity or not. If it is in a financial service activity, only an Indian company who has made net profits for the past three financial years, then only it can make an overseas investment in a foreign entity engaged in financial service activity. Earlier, it was not allowed. Earlier, only an Indian entity who was itself engaged in financial service activity could make an overseas investment in a foreign entity engaged in financial service activity. Now, any Indian entity can do it, but condition is it should have posted net profits for the preceding three financial years. Of course, it should the Indian entity should also be regulated by the yeah, the second point, uh, there's an exemption which had been given. An Indian entity who is not registered with the financial service activity also can invest in foreign entity in the financial service activity. Now, for resident individual. A resident individual can make an overseas investment only up to USD 250,000 USD per year, which is the liberalized remittance scheme. He can either make an overseas direct investment or an overseas portfolio investment, which we will discuss in the next slides. So resident individual can acquire equity shares through rights. It can acquire shares through bonus issues. It can also do again capitalization of its receivables. If a resident individual has some receivable, foreign receivable, it can capitalize it into equity shares. It can get sweat equity shares. Sweat equity shares basically are like ESOPs, or it is issued to them on the work done by them. Now, one important thing is an Indian and resident individual can acquire without any limit foreign securities by way of gift or from inheritance from a person resident in India or a person resident outside India. Who is this person who is giving a gift, who is a relative, and who has earned the foreign exchange as per the rules and regulations. So I'll just clarify again. And resident individual has a limit of up to 250,000 USD by which it can make an overseas financial investment. But if it has received any gift, or if it has received shares by way of inheritance by a person who was either a resident or a non-resident, but who is his relative and who has acquired these foreign securities when he was as per the rules and regulations at that time, when the relative had acquired those shares, he has acquired it as per the FEMA rules and regulations, and he has gifted these shares to the resident individual. He has gifted, the shares have passed on to the resident individual as inheritance. Then there's no limit for the resident individual for acquisition of these shares. A resident individual can receive shares by way of ESOPs, by swap of securities. Again, you have to see the sector limit. You have to see. And resident individual cannot invest in a entity which is engaged in the financial service activity unless it has received those shares by way of inheritance, or by sweat equity shares, or acquisition by way of minimum qualification shares. When you become a director, you get those minimum qualification shares. Or if you receive the shares by way of ESOP, then only can you acquire shares in a entity engaged in a financial service activity. Now, there is also an option for an Indian entity to make an overseas investment by way of deferred payment. That means upfront payment may not be required to be done. It can be done in a deferred payment. However, there's the agreement, the share agreement itself should mention that it's a deferred payment agreement, and the terms of the deferred payment should be mentioned. Also, when you're considering the 400% limit, you have to check up as per the total amount to be invested, not the deferred amount, or the amount which you're paying now. You have to consider total amount which you have to pay, that you have to consider for your 400% limit. So the deferred part will become part of your non-fund based commitment. Once you make the payment, it becomes your fund based commitment. Again, the full consideration should be calculated for the pricing guidelines. So you should consider the full value of amount which you are going to invest for calculating the pricing guidelines, and not only the deferred amount. Yeah, one more major condition is the foreign security equivalent to the amount of the total consideration should be received upfront to the Indian entity. So Indian entity can acquire shares on deferred payment only if it receives the shares upfront, though payment is being made deferred. But again, the total amount should be calculated for considering the 400% net worth, and the total payment should be calculated for considering the pricing guidelines. Similarly, a company may an Indian entity or person resident in India may transfer investment in equity share capital if it is in compliance with the pricing guidelines. The documentation should be there. The share transfer form should be there. The reporting requirements should be there. So any Indian entity or a person resident in India who has acquired shares of a foreign entity can transfer these shares to another person, but it should be compliance with the pricing guidelines and documentation should be there. If he's transferring it to a a person who is resident in India, it should be that resident Indian should be permissible under the FEMA rules for being able to acquire these shares. Then only can he transfer to the Indian resident. But he can freely transfer to a person resident outside India. Now, in any case, if there's a disinvestment by way of liquidation or by sale by way of demerger, the amount should be realized within 90 days. So that is a precondition when you're selling off any equity shares or you're transferring or the foreign entity has been liquidated or the transfer is on account of merger, amalgamation, anything. The amount should be consideration should be received within 90 days. If it's a transfer on basis of amalgamation, then that NOC should be there. I mean, it should be as per the laws of the country, and that NOC of the host country should be there if the transfer is on account of merger, amalgamation, or demerger. One thing more to keep in mind is when an Indian entity is invested in a foreign entity, it cannot disinvest within 1 year. So they don't want they don't want the short term investment. They want, if some companies making an overseas investment, it actually wishes to do business over there. It actually wishes for a long term overseas investment and not not mere try to earn some quick profits. So an Indian entity can only disinvest from a foreign entity after 1 year of making the ODI. And when there's a transfer or liquidation, the Form FC also again has to be filed. Form FC Section G has to be filed within 30 days of the receipt of the disinvestment proceeds. Now we go to overseas portfolio investments. Now, what's the difference between overseas direct investments and overseas portfolio investments? Overseas direct investment is when an Indian entity or a resident individual is investing in a foreign entity to exercise control or exercise significant influence or to have some shareholding rights. Whereas overseas portfolio investment is when an Indian entity or a resident individual is just investing in a foreign entity for the sake of financial returns. It's like an investment, the financial investment which we do. So those are overseas portfolio investments. Now, an Indian entity, the conditions are an Indian entity can make overseas portfolio investments, but cannot exceed 50% of the net worth. Net worth again should be considered as per the latest audited balance sheet. Then OPI again, the rules and the regulations have been mentioned. The Schedule 1, Schedule 2 have been mentioned. They are different for listed Indian companies and unlisted Indian companies. Now, there's some certain conditions which have been kept, like listed Indian companies can, if they have made some overseas portfolio investments, if they made some overseas portfolio investments beforehand and they've earned some dividend or if they've earned some interest, so they can reinvest this amount back in that overseas portfolio investment. This is only allowed for listed Indian companies and resident individuals. Unlisted Indian entities cannot reinvest the dividends or the interest in the overseas portfolio investment. Now, for unlisted Indian entities, can make OPI on only specified instruments. It is restricted to the following clauses, like rights issue, bonus issue, capitalization of receivables, swap securities, mergers and demergers. So for the unlisted Indian entities, there are various restrictions. While listed Indian entities, there is more options available because they are already very regulated. The listed Indian companies are already regulated. So for them, they can reinvest the proceeds also in overseas portfolio investment. And there are a lot of more options also available for the modes of making the OPI. While unlisted companies can only do more OPI by way of rights issue, bonus issue, capitalization of receivables, swap of securities, merger, demerger, and amalgamation. So, to conclude ODI, if you want to study the ODI, you have to study the latest rules and regulation of 2022, the directions of 2024. We have to provide a statutory auditor certificate, so we have to do the documentation thoroughly. We have to follow all the auditing standard. We have to follow the auditing standards also of documentation, of checklist, of QC, of MRL. Everything should be there. So now let's discuss what are the various form filings which are there in FEMA. So form FCTRS. Basically, the full form of form FCTRS is foreign currency transfer of shares. So basically, if there's a transfer of shares of an Indian company by a by a transferor and a transferee, out of which one is a resident and one is a non-resident. So if the shares of an Indian company are being transferred by a resident to a non-resident or from a non-resident to a resident, then foreign country transfer of shares has to be filed. It has to be filed within 60 days of the date of remittance or the receipt of consideration or transfer of shares, which was earlier. Now, where do you have to file the form? Basically, a lot of the forms with respect to the FDI and with respect to FCTRS, they have to be filed on the firms portal, FIRMS. There's a firms portal. It is basically a single master form. So in that firms portal, you have to log in and you have to file the forms over there. So all your form FCTRS, your form FCGPR, your form LLP1, form LLP2, these are all have to be filed in your forms portal. Who is required to file the form? The transferor or the transferee who is resident in India. So when the FCTR is applicable, the shares of a Indian company are being transferred between a resident and a non-resident or vice versa. So who has to file? The transferor or the transferee who is the resident in India, not the company whose shares have been transferred. What are the documents which are required? A consent letter of the transferor and transferee will be required. The valuation report. See, there's a transfer of shares being taking place. The valuation report will be required. Then share transfer is being taken place. A share transfer forms will be required. Share purchase agreement will be required. Then there may be no objection certificates which may be required from the income tax authorities because see transfer of shares is being taken place. Suppose transfer of shares from a resident Indian to a non-resident. So the resident Indian is earning a profit out of the transfer of shares. So it will require NOC from the income tax authority whether the taxes have been paid or not on the capital gains. Then if a non-resident is acquiring the shares, then a KYC of the non-resident is required. Whenever a non-resident is investing either by way of FDI or by transfer of shares, the KYC of the non-resident transferee will be required. This KYC will have to be got it, this NRI, non-resident Indian, will have to get its NOC from its foreign bank. Will have to get its KYC from its foreign bank. Then form FCGPR. Form FCGPR, basically the full form is Foreign Currency Gross Provisional Return. This is for the entities who are issuing shares to foreign entities. So if any Indian company has issued shares to a non-resident investor, form FCGPR has to be filed from 30 days from the date of allotment. Who is required to file? The Indian company who is issuing this capital instruments to the non-resident. Documents are valuation report because shares are being issued to a non-resident. So the valuation report will be required. Money will be coming in from outside India. So a foreign inward remittance certificate will be required. Then whenever FDI is involved, a CS certificate is required. Who will say that all the conditions of the RBI have been complied with and also Companies Act have been complied with. So they have to, and in this transaction, so the CS has to certify. Again, the board resolution of the company who is allotting the shares will be required. Copy of the KYC of the non-resident Indian. As I said, any type FDI is being done, the non-resident Indian is investing in a Indian entity. So the KYC will be required of the non-resident Indian. There may be a letter of debit authorization that the payment has been received. So that will also be required. That payment has been come in, and the FIRC will also be required. Form FC, including section E certificate, it's for the ODI. We've discussed it in detail. The full form is financial commitment. When it has to be filed, if any Indian entity or resident individual is making an overseas investment, giving overseas loans, giving a guarantee overseas, or pledging his shares to a foreign entity for a loan taken by a from a foreign bank. Now, time limit. Now, for an ODI, for making a financial commitment, these documents have to be submitted at the time of making the transaction, not after it. So, the AD bank will not make the remittance only till the time the Form FC is submitted. Okay. So, who is required to file? The resident or the Indian entity making the foreign commitment. The important documents are the statutory certificate, which we have already discussed, valuation report, the agreement of share purchase, loan, pledge, guarantee, whichever mode it is, board registration of the Indian entity who is making this foreign investment, and underlying signed document, the purchase document, the loan document, the pledge document. And various checkpoints which we have already mentioned. You should check if it is within 400% of the net worth, whether it is at the fair value, check whether the investment is not prohibited as per the FATF or as per the restriction as per the rules, whether the share certificates have been submitted to the AD bank, if the previous APR has been filed or not. Okay, so now we'll move to the Form DI. Form DI is basically for downstream investment. Now that this is basically a form for indirect FDI. So for example, if an entity has received FDI, this entity is making a further downstream investment into another Indian entity. So the second Indian entity is indirectly receiving FDI. So it's a downstream investment. So for that, Form DI will have to be filed. It has to be filed within 30 days of date of allotment of the equity shares to the second level. Again, this form has to be filed in the SMF firms portal, the firms portal of the RBI. Who is required to be filed? The Indian entity having this FDI and investing in the second entity. So Indian entity who has received this FDI and who is doing this downstream investment into another Indian entity, he is required to file the Form DI. Again, the important documents for the Form DI are the valuation report, because see, Form DI is an indirect FDI. So what all documentation will be required for FDI will be required for Form DI. Valuation report, the CS declaration certifying that it is within the rules and regulations of RBI, of FEMA, and of the Companies Act. Then there's one declaration which has to be submitted. And as I mentioned earlier, you have to report at the DPIIT portal also. So one Form DI has to be filed at the RBI portal, and another Form DI has to be filed at the DPIIT portal. So again, when you have to file Form DI, you have to understand there are two filings which have to be done. You'll have to again make a registration in the DPIIT portal. You have to create a login. You'll have to then you'll get the login credentials, and then you have to file. It takes time, so you should always have time in hand. Then there's Form LLP1. Form LLP1 is basically if an LLP is receiving FDI. If an LLP is receiving foreign direct investment, it has to file the Form LLP1. Who has to file? The LLP who is receiving the foreign direct investment. Matlab, who is receiving any capital contribution from a non-resident Indian. It has to be filed within 30 days of the date of the receipt of the consideration. Has to be filed again at the firm's portal. The documents again, what all documents will be required for the FCGPR will be required in LLP1. Your valuation report, your LLP deed, of course, because it's LLP, so LLP deed, consent letters, the declaration. Now, when you're doing a Form LLP1, you should always check whether this money which is coming in is in a repatriable mode or non-repatriable mode. If you go through the Form LLP1, if the non-resident Indian if the NRI is investing in the LLP through his NRE account, it comes in the repatriable mode. And the LLP the LLP can, when it's distributing the profits, it can transfer that money to that foreign account of the non-resident Indian or to its NRE account. But if the money has come in from its NRO account, then mostly it is a non-repatriable source, and the LLP, when it is distributing back the money, it can only deposit it back in its NRO account and not in the NRE or the foreign bank account of the partner. Form LLP2 is when on account of disinvestment or transfer of capital contribution or profit share between an LLP to its partner. So LLP1 is when it is receiving FDI, LLP2 when the LLP is transferring the profit or capital contribution to its partner, to its non-resident partner. Again, it should be filed within 60 days from the date of receipt of funds. The who has to file it, the transferor or the transferee, the resident transfer, the resident transferee shall file this form. Sorry, the LLP, the Indian LLP has to file the form because it is remitting the money. The Indian LLP has to file the form. The documents again will be required as LLP deed, the valuation report, the consent letters, standard declaration, tax compliance because the remittance is being made outwards to a non-resident. He must have earned a profit. So whether he has paid tax on that. As I said, you have to check whether the money which has come in, it has come in from the repatriable mode or non-repatriable mode. That's what you have to check. Form APR is the annual report. Any entity who has made an overseas financial commitment has to file a Form APR annually. Currently, the due date is 31st of December. It has to be filed in hard copy. So, what all things required in Form APR? The Form APR is as very few amounts which have to be mentioned. The amount of the net profit of the foreign entity, the amount of the reserves, the net worth of the foreign entity has to be mentioned in the Form APR. So you require the audited accounts of the foreign entity if the Indian entity exercises control over the foreign entity. So even if an Indian entity holds more than 10% more than 10% shares in the foreign entity, it exercises controls and the audited financial statements of the foreign entity will be required. There was one case for a client wherein for the foreign entity, the audit was not applicable in its country. So basically, it was a US company, and or statutory audit in that country was not applicable. But the Indian company had more than 10% investment in the foreign entity. So the AD bank didn't let go of that point. They required an audited financial statements, but they allowed the financial statements to be audited by an Indian chartered accountant. So later on, we had to get that foreign the financials of the foreign entity audited by the Indian chartered accountant, and that was submitted to the AD bank. So what was submitted with the APR? The form APR itself, a simple form wherein the net worth and the profit and loss of the foreign entity is mentioned, the audited accounts of the foreign entity, the board resolution of the Indian entity adopting the accounts of the foreign entity will be have to be mentioned. Again, this form APR has to be signed by the statutory auditor as well as the management. So the director also has to sign and the statutory auditor also has to sign. So whenever an Indian entity is making ODI, even while making an ODI, the statutory auditor has to give a certificate in section E. Again, in the on 31st December, before 31st December, form APR has to be filed, wherein the statutory auditor has to sign this form APR also. Now there's a form FLA. Who has to file the form FLA? Any Indian entity who has either received FDI or made an ODI. You have to file form FLA. Form APR only who has to file? A person who has made an ODI. But form FLA, any person who has received FDI and made ODI, both they have to file the form FLA. Currently, the due date is 15th of July, and there's no attachments which have to be submitted along with this form. There's a separate portal. The Flares portal is a separate portal where the form has to be filed over there. For the other forms, there was a forms portal. For the FLA, there's a separate Flare portal. So basically, you have to put in the amounts of the paid up share capital of the foreign entity, the reserve and surplus of the foreign entity. So you have to put in the basic amount of the basic balance sheet items of the Indian entity and the foreign entity. This is basically the government or the RBI wants a statistical data of the Indian entities who have either received FDI or who have made ODI. What are their profits? What are their net worth? And what is the profit and net worth of the foreign entity? They want a statistical data, or how many employees they've employed. What are the current foreign currency receivable or payable? So this is what they want. Then there's a Softex form also. If there's any Indian entity who who is providing export related IT services, they have to file the Softex forms also. So this we have seen a lot of clients are missing out on filing these Softex forms. So if you go on the Softex forms, they have listed out which all type of IT services are covered for the soft tax applicability. So you should always go. Earlier there was a limit for the amount for the export amount. Now there is no limit. Even if there's 1 rupee of IT export service, you have to file the soft tax form, and you also have to get yourself registered with the Soft Tax Authority of India, the STPI Authority of India. The important documents to be filed with the SOFTEC form are the export invoice, the FIRC, because you're providing export services, FIRC will be received. The contract between the Indian exporter and the foreign service receiver. The invoice of the internet service provider. Why? Because see, the only proof of providing software services, you are going to require a lot of internet. So you have to provide the bill of the internet service provider. Now, this soft tag also again has to be digitally signed by the director, and it has to be filed. So various soft tag forms are the SERF form, the MERF form, the form APR, the various forms which have to be filed. There's some monthly forms. The annual APR is again an annual report which has to be filed for the soft tags also. Form 15 CACB, basically it is not part of FEMA, it is part of the Income Tax Act. But whenever any remittance is being made overseas for purchase of for purchase of service overseas, so Form 15 CSCB has to be filed with the Income Tax Department, basically mentioning whether the applicability of TDS and how much is TDS applicable. So we've crossed 7 o'clock. I just have maybe 2 or 3 slides. We just finish in 5 minutes if you allow. So there are two online portals in FEMA. One is the Flare portal and one is the Firms portal. On the and the form ODI, as we said, the form FC in form ODI and form APR have to be submitted in hard copy. Now, when you're doing a registration in the firms portal, there are two type of logins you have to create. One is an entity user login and one is a business user login. So entity user login, who will create that entity whose shares are getting whose share capital is being getting transferred or whose share capital is getting changed. So for example, an Indian entity who is receiving foreign direct investment. So this Indian entity will create an entity user login because its shares are being its share capital is getting changed. So that will be an entity user login. And another entity will create a business user login. Business user login, basically if the shares are being transferred to a resident company, and who has to file the forms? Basically the person who is responsible for filing the form FCGPR or FCTRS, he is the business user login. So for example, if there's an Indian entity whose shares are being transferred from a non-resident to a resident Indian, so the company whose shares are being transferred will create an entity user login, and the transferee, the Indian resident transferee who's receiving the shares, will create a business user login. For both creating these logins, you have to, both the entities have to mark an authorized representative person. So the director, they can mark the director or any person as an authorized representative and have to submit a letter of authority and submit the PAN card of the authorized representative while making the login. Also, also the change when you want to give the email of the authorized representative, make sure you give the email ID which will be regularly available with you, because to change this email ID, it's a little lengthy procedure. You have to, again ask the RBI portal. You have to you have to shoot an email over there to get the authorized representative email changed. And you always require an OTP. So whenever you're logging in, you require an OTP. So always put those email IDs wherein that OTP will be easily possible to be retrieved, even in the future period. So just a small example, a form FCTRs needs to be filed, and Indian company A is selling the shares of an Indian company B to a foreign company. So who will create the entity login? Entity login will be created by the company B because whose shares are being transferred. And entity A will create the business user login. Now, if a form FCGPA is being filed or form LLP is being filed, but if an Indian entity is itself receiving the FDI, so the Indian entity, now there's no other entity. So this Indian entity itself, his shares are getting transferred, and itself it is responsible for filing the form. So both the business user login and the entity user login will be created by the entity receiving this FDI. So in case of foreign currency transfer of shares, the entity login and the business login will be different. But in case of FDI or LLP1 forms, the form FCGPR, the entity login and the business login will be of the same person. Then the Flare portal, where the FLA returns are being filed, is the Flare portal. Again, when you're logging into the Flare portal, you have to give the authority letter and the verification letter. You have to mention the PAN of the authorized person. Again, please ensure the correct email ID is given for the registration. So I end my session with this. Thank you. Any more questions? If I can take any questions. Hello. So, any questions which I need to take? Okay, sir. So for one question is, what is the role of RBI and SEBI in with respect to the FEMA? So RBI is basically the facilitator. RBI has authorized the AD banks to approve all the documentation and to check all the documentation. Only in few cases do you have to go to the RBI. SEBI is with respect to the listed Indian shares. So it is not that much into FEMA, but it is mostly the RBI who is regulating the AD banks. Now there's a question. The definition of non-resident is different as per Income Tax Act and FEMA. So which should be applied for bank accounts are concerned? For bank account concerned, you have to see the non-resident as per FEMA, not as per income tax. You have to see as per FEMA. Now the third question is the RBI approval required for capital infusion in a foreign subsidiary by way of conversion from partly paid up shares to fully paid up shares? We are facing difficulties in this as per earlier FEMA rules. The partly paid up share route was allowed, but not now. The AD bank is dealing this as the statutory certificate is mentioning this by way of note. Now, does this go as per a deferred? See, in the ODI rules of regulation of 2022, they've allowed a deferred payment also. So if it goes in the deferred rules, but then it should have been mentioned in the it should have been mentioned in the when you're acquiring the share equity shares, the shareholders agreement should mention about the deferred payment. But I think over here it's not deferred payment because the partly paid up shares are being converted to fully paid up shares. But I don't think any RBI approval will be required for that case. But you just have to go with the rules and regulations which were there preceding. Is commenting on pricing valuation required for Form FC on initial subscription? Yes. Initial subscription, see, of course, it's going to be at face value, but you do require a valuation report. The AD bank will ask you for a valuation report because, of course, when you're doing an initial investment will be at the face value because you're just starting a new company, but a valuation report is required. You can say it is a new, the valuation report can state it is a new company, it has been incorporated, so the face value is the fair value. Is there a software for FEMA compliance? Currently, even I am not aware of any software for FEMA compliances. But we do have a lot of checklists which we have made. So we have a lot of checklists and a list of documentation which we have maintained, which will be required for each type of transactions. And what we do is we also prepare these MDRs wherein we note down what all practical issues we faced in certain transactions and what all discussions we had, what all technical consultancy we took. So at least in future we can reference those learn from our past experience and get a transaction done much easy better in the future cases. One question is, can a non-resident Indian send funds to his own Indian savings account jointly with his father who is resident? Indian account is opened when he is resident by his father. Non-resident Indian can send funds to his own Indian savings account jointly with his father who is resident. Indian account is opened when he is. I just didn't get the last line. Indian account is opened when he is resident by his father. If you can just help me clarify that line, I can try to answer. And yes, I'll share the PPT with the committee. They can share it with the people who require it. Sir, any more questions? Okay. Yes, sir. Yes, sir. Thank you. Thank you, sir. Thank you.